March 25th, 2020. This is one of those interesting days where you end up getting a measured move of the opening spike, but in the opposite direction. It happens occasionally. I have another example. Spike, the measured move in the other direction. August 10th, 2023 had the same thing. You can see we had this to this and measured move down to that low. So, sometimes that happens, which I think is pretty interesting. When you got this channel or the open of the day, on bar one and two. It's a good looking pair of bull bars, yes, but you have to look at the context of it and that we're in a bull channel. And this is a very crude drawing, but you get the point. We're in some sort of bull channel here, and we broke out above the bull channel on bars one and two. And when you break out of a bull channel to the upside, you're breaking out of the channel line, and there's a 75% chance of failure within probably 5 bars. So, these breakouts to the upside out of a channel line normally don't last more than 5 bars. And usually when you get the breakout, the reversal attempt is going to test the trend line. So you can see here, we broke out of the channel line, and then bar five got vacuumed down to the trend line, which is pretty likely. Additionally, something to keep in mind on days like, today, we started to go sideways around bar 20, and there's a 90% chance that we're going to break out of the 18 bar range. So if you bought above, say, bar 12, it's double bottom, it's a reasonable buy. Then you're holding through 20 and you start to go sideways. I think it's okay to still hold because this is just a tight trading range, and it could be a sideways three push pullback, which is what it was. 20 to 23 being, or sorry, 21, 23 being the first push, 26, 27, second push, 29, third push. So it's a sideways three push pullback, and it's in a tight trading range. So you don't really need to exit below 26. You don't really need to exit below 29. Their potential swings short, but they're really not very good unless they get follow through, and you can see none of them do. And so what I would do in that kind of situation is have a stop maybe below 16, at this point. And if bar 30 is a bear bar closing near its low, below the bottom of the tight trading range, you just get out below it. But chances are it's not going to be, and you're going to continue higher. You also got to note that this is a breakout of the tight trading range. When we did break out of the tight trading range on bar 31, any trader who sold above the high of 24, which is the top of the tight trading range, was never let out at break even during bar 33. So what does that mean? That means there are trap traders there. So any trader selling above this high was not let out at break even on bar 33 or 34. Additionally, any trader selling above bar 32, because bears will sell above bear bars hoping it's a trading range, they were never let out at break even either. You can see they tried to test it on 37, but they didn't get that close. So you have multiple open gaps, and when you have multiple open gaps, it's usually a strong sign for the bulls. Since this happened in the beginning of the day, it's a strong bear move. Sometimes, you got to think it could still be a trading range day. And in trading range days, gaps close. And you can see at the end of the day, we did end up closing all these gaps. But for now, you can see that it's clearly bullish. There's clearly open gaps just by the market. And this is important because you got to understand when bears start to make money, the bulls are getting less strong, right? If bears can't make money, the bulls are obviously strong. And so you can see here, bar 36, you could argue is a breakout point, and we broke out above it and we got back below it. Now we didn't close the body, didn't close below the, there was no bodies overlapping. And when no bodies overlapping, it's still a gap on the line chart. And you can see kind of the same thing happened here. We have an open body gap, not an actual gap, because bears who sold above 41 got out during 45. You can see right there, sold there, sold more higher, got out. So, but what is this telling you? This is telling you that the bulls are not as strong as they were. They're still strong. It's still reasonably good for the bulls, and it's still okay to be long. But this is telling you that it's not as strong as it was back here. And so you should essentially be, more cautious. Another thing to consider, so back to the beginning of the day, 1 and 2, strong bull bars, but a lot of times this ends up being a trap. I have a bunch of examples, those kind of days. I just want to go over them. Pair of bull bars or bear bars on the open. We'll look at trading ranges because that's kind of what it was. And I want to find one where it just kind of trapped traders like this one did. And that's kind of a trap wedge pullback. Yeah, I'm having trouble finding a good example. There's some good ones on the trend that I looked at earlier, but okay, whatever. Doesn't matter. But the point being, when you get a pair of bars on the open, just a lot of times it makes more sense to wait for a third one, because if it's going to be a bull trend day, you're going to have like 80 plus bars to enter. So it doesn't really matter if you enter on bar 2 or 3. But you can see on bar 3, a lot of those bulls who were long, failed breakout. You get bar 3, closing somewhat near its low, and follow through on bar 4. You know we're probably going to the bottom of the channel line, so a lot of bears will sell below 4, taking a chance we get a swing down. It's early in the day, so they don't know what the day is going to look like, so it's okay to take the short, hoping we get follow through. When you get bar 5, I would take part off, probably scalp a small piece, maybe scalp 40-50%. And then when you get below here, I would scalp a lot of the rest and maybe hold on to 20 or 30% of it. And you get more follow through. So you have now 4 straight bear bars, 5 straight bear bars to bar 7. But you can see that bears who bought below bar 1 and bought more lower were able to make money on bar 8. So you immediately know that once we get below here and we come back and close the gap, it's more likely a trading range day than it is a trend day. Additionally, when you get bar 9, it's a big bear bar, but bears see it as just a second leg, and they end up buying back shorts around the below of it. And bulls know that we're probably getting to the 8 low, as do bears. So traders are essentially buying the close of 9, and we get back to the 8 low. Once bull bears are failing to keep any sort of gaps open, it's probably a trading range day. And if it's a trading range day, that this was a possible swing short, and this was a possible swing short. And so bulls bought below these bars, betting it was going to fail. And so you have trap traders here. And on trading range days, trap traders are normally let out. So it's reasonable to think we're going to get to the 3 low or the 4 low. And if you think a little deeper about it, it makes even more sense to buy above 12 because, like I said earlier, you were probably getting here. Traders who buy there have about an 80% chance, if they buy more above a bull bar, getting out around break even. So maybe about an 80% chance we get here, 60% chance we get all the way back here. Or I would argue also 60% chance we get all the way back here, 80% chance we're able to get here, because traders who buy the close of 2 buy more above 12. They're trapped, and so they should have an 80% chance to get out around break even, which this is the midpoint. If you bought here, bought more above a reasonable stop order here, get out there, and they have a 60% chance of getting back up here. But if you're buying above bar 12, that by the time it gets up here, it's probably going to be bar 17 or 18, and there's a 90% chance we break out of the opening range. So you think we might have to get all the way up and break out. So it makes even more sense to buy above 12 and hope for a swing. It's not always going to be clear, swing trades, but that's kind of the point. 13, follow through for the bulls. 14, more follow through for the bulls. So now you have 5 straight bull bars, a bull micro channel. There are probably buyers below the first bar to trade below the prior bar, which I guess happened on 11, but I saw this as an attempt up, and this was the second leg down for the bears, and then we got a reversal up. Buyers below 15 on, obviously it's a bad low 1 short in a bull micro channel. Bears are hoping it's a second leg trap and that we're going to get back down here, but probably not. 17, sellers above 16, and it's 1 pullback, 2 on 18, so it's 2 legs up. Bad follow through 19, and we entered a tight trading range. You can see essentially on 21. I'm trying to think, and there really isn't a reason. Obviously you're gonna have an inside bar here. Bears sell above, bulls buy below. Bears are gonna sell above, bulls are gonna buy below. When you're in a tight trading range, traders are gonna buy the bottom of it. Traders are gonna sell the top of it. Traders are gonna buy the bottom of it. Traders are gonna sell the top of it, and that's kind of what we had happen here. And we end up getting a breakout, closing above the high on 31. And like I said, bears couldn't fill the gap on 32. So reasonable to buy above 33, high 1 swing trade, knowing that we're probably going to get here at least. And you can assess the strength from there. And in these kinds of conditions, you can have stops, measure move down of whatever bar. It's risky to have a stop measure move down to 40 because of how big these bars have been. And when you can just have your stop below 37, which isn't that far, but you can have stop measure move down of here. You can have your stops, below. So once 34, 35 happens, you can put your stop below 33. Once 37 happens, you can put your stop below 37. Once we get probably 44, your stop goes below 42. And you can just keep putting it below, those lower highs or those higher lows all the way up. So, you can go stop here, stop here, stop here. And then obviously you get a breakout here, stop here. I think you get, 52, that. So first off, 52 below should have been bought, right? Traders will normally buy it. And it's probably okay to exit below 53, knowing we're probably getting to the moving average and this is a bit overdone. You also probably have a pretty good profit at this point. So it's okay to take, to exit below 53, I would think. And you get a kind of a bear surprise on 54, 55. Definitely exit below 55 if you're still long. it is the first test of the moving average, but it's 3 straight bear bars, which is enough for a second leg. You know that bulls should have bought the 52 low, so we're probably going back there. So traders will buy above a bar like 62, maybe not 57 because this is a tight bear channel, and so the first reversal up's likely to be minor, and it was. And then you get 62, second reversal up, high two buy, just below the moving average. Probably okay to take the buy looking to get to the 52 low. It would have been better if 62 closed above the moving average, but it didn't. And yeah, probably, too late to trade in the day on 75, but you also know it's a trading range day and we might get vacuumed back to the open, which is essentially what we tried to do. I'm trying to talk more about trade management in this video than I am about the actual price action because I do most of the videos on that. So I'm just trying to work a little bit on how, I would manage these trades and how I can improve on it in the future. But yeah, I think the big thing is don't exit in this tight trading range unless you get a breakout to the downside. Because I do that. I especially used to do that just all the time. Maybe I'd take a good buy here, but I just end up getting out down here, and have a really hard time getting back in. So if you're a swing trader, I think it's totally fine to sit through a 3 push pullback, and then you get follow through. And if you do exit somewhere in here, you can buy again above 30, 31, or 33, or add on above pretty much any bull bar. But yeah, that was really it.